Welcome, Gartner employees. This is Brian Skinner. I'm a certified financial planner. Today we are talking about another important topic for Gartner employees, and that's the ESPP plan, which stands for Employee Stock Purchase Plan. I know it's a mouthful. They love acronyms in that Gartner handbook. We want to dig into this plan today because it's really important as a benefit to you as an employee in a way that you can build retirement savings for yourself to be used later in your life. So who is this video for? This video, like a lot of the other videos about the savings plans, are for the Gartner employees who have a little bit of excess cash flow to save for a later point in time in the future. The 401k plan is a place that I'd probably start, but the ESPP plan is that next logical step that you might consider in building out a retirement savings strategy for yourself. So let's talk about how the ESPP plan works. Is it generally structured? So first and most importantly, to entice you to use this plan, the company gives you a 5% discount off the share price on each purchase that you make. Hypothetically, if the shares were trading at $100, your purchase price would be $95. So you get that free $5 per share accrual in your basis as those shares mature in your account. So how does it actually work? The deductions are made from payroll deductions, basically, just like a 401k contribution is. The money comes to you in your check, you'll see that deduction to your ESPP plan right in your pay stub available on Workday. Dollars set aside for the purchase. The shares are purchased at the end of the period. You can only enroll in the company ESPP plan 4 times a year, and those months are February, May, August, and November. And that is enrolled in via Workday as well. A couple things to know is that the dollars that go into this plan, they are after-tax dollars. Unlike a 401k plan that gives you the ability to make a pre-tax contribution, you're buying these shares in your ESPP plan with after-tax dollars. So you've paid tax on those dollars already, and then you purchase the shares, which means eventually when you sell them one day, they are taxed at capital gains tax rates as opposed to income tax rates. Depending on your income level, capital gains tax rates can range anywhere from, for most people, 15 to 23.8%. There is some tax strategy that if you can keep your income really low in certain years, you might be able to pay a 0% tax rate on that. Again, really, really important to always keep taxes in mind. It's so critical to understanding how much you keep of a certain investment rather than just how much you make in a nominal way. What matters is how much ends up in your pocket after the tax man has had his take. There is an IRS limit to how much you can put in this plan. It's $25,000 a year. That is typically indexed to inflation. It goes up a little bit, but right now it's $25,000. So let's talk about the pros and cons of a plan like this. Not all good. The 5% discount is hefty. Other companies range anywhere from 5 to 15%, but it gives you a way to directly participate in a company that you work for. You have skin in the game, so to speak. If the company is successful, ride that wave with them. The 5% discount is meaningful, right? A 5% appreciation potential is a lot, especially when compounded over time. That is the real big value to it. And you working for the company have maybe the best vantage point in how you feel the company is run and going and the direction the business is headed in, and if you feel comfortable in that investment moving forward. As a Gartner employee, you can look back at the stock history. The stock has done well in the last 20 years. But as we all know, past performance is no guarantee for future success. So really take a hard look at how you feel the strength of the company is, and do you feel comfortable investing in that company-specific single equity. The cons of using the ESPP plan are what we really talked about regarding the stock itself. If the stock thrived over the last 20 years like it has and thrives again in the next 20, it will prove to have been a good investment. But if the stock doesn't thrive in that same way, or maybe is negative or flat, then maybe it would have proven to be a poor investment. What it really comes down to is the concentration risk that you take on by buying position in one single company. The history of stocks over time is that single entities are not able to be strong performers indefinitely. You think of IBM, AT&T, Intel, General Electric. These are companies that were very strong investments in stocks for decades until they weren't, right? The same can be true for Gartner or any company as well, right? The sustained success is difficult to navigate, but possible. You just need to take on that concentration risk in how it manifests itself in your plan and how much percentage of your total savings are you comfortable having in one single company? So those are the pros and cons of using the ESPP plan. It is an important part of your benefits offering through Gartner. Again, you can enroll through Workday. It's right in the portal, and it gives you that ability to do so 4 times a year, up to $25,000 in contribution limits, and you get a 5% discount on that stock price. I'm sure a lot of people watching the video may know someone at Gartner who's been there for 25 or 30 years and has accumulated significant savings because of this ESPP plan. That doesn't guarantee the same can happen to you over the next 20 years, but analyzing and doing that due diligence for yourself on the company and how you feel about it and its prospects for you and your retirement savings is a good place to start. It can be a powerful tool, so that's why I want to provide some education on it. Thanks so much for listening. I really hope you enjoyed it, and stay tuned for our next video on other benefits that are available to specifically only Gartner employees.